Hello friends, Jeff Boxler here talking about how your mortgage rate is determined, and so you can understand those levers and how you can play the game to ensure that you get the best interest rates out there. If you like this content, please subscribe, please like, please share, and make comments below. I'd love to hear your feedback and dive deep into whatever commentary, whatever topics that would be useful to you to ensuring that you are a responsible homeowner and that you have success going into the housing experience. So that said, why and how we figure out your mortgage interest rate. The most important piece to your mortgage interest rate, the bedrock, is your credit score. So if you've got great credit, moderate credit, terrible credit, all of that goes into the engine, the rate engine, to determining what you get as an interest rate. And it can vary widely, and it can lead to dramatic increases or decreases in interest payments over time. So take your credit very seriously. Make sure you have auto pay on as much of it as possible. That's going to get reported to the credit bureaus. And just keep an eye on that. There's plenty of applications out there that give you an idea of what your credit score is. And know that the mortgage industry uses a different credit weighting system, so your credit score might not be exact to that, and typically it's lower than what you'll get on those free services. But that said, it still gives you an idea of whether your credit's tracking up or credit is tracking down. And always get a free credit report once a year to see if there's any blemishes that come up that you're not aware of, or someone's using your credit that you're not aware of. A medical collection, those tend to be the bane of most people's existence in regards to credit scores, is medical collection. So stay on your medical bills as much as you can. Other than that, how much are you putting down? So depending on, if you have a VA loan, you can put 0% down. Okay, if you're FHA, you can put as little as 3.5% down. Conforming loans, you're putting 3 to 5, etc. down. And then jumbo loans, you're typically putting 20% down, though you can often do even 10%. But those variances of how much you're putting down matter. Why does it matter? Because it affects the risk that the bank is taking on you. That the less you put down, the more risk that the bank has, that if you start missing your payments and the bank has to take back your home, which is the worst of all situations, both for you, but also for the bank. The bank does not want to hold real estate, despite common headlines making you think that the bank would love to take back that property. They don't. It's very legally expensive and timely and costly to them, which they'd rather just get your mortgage and get your mortgage payments on time from you every month. So that said, though, the risk of you putting less down or more, or the lowering of risk by you putting more down, leads to an interest rate, and that interest rate is going to be lower if the risk is lower to the bank. It's going to be higher if the risk is higher to the bank. So think about it that way. FHA and VA are different in some respects in regards to limited down because of the federal government doing they honor and back those mortgages in a different way than the rest are, and allows for mortgage providers to offer still low interest rates on those, even though you're putting limited down. That said, it's a factor, though, that you want to keep in mind, and a lever as you're trying to figure out, should I save up more money? How much is it going to save me on interest rate by putting another 5% down, 3% down, etc., versus where you're at today. Another factor that plays into whether what interest rates you're getting is the loan amount. So if you're getting a conforming loan amount, a high balance conforming loan amount, an FHA, a VA, a jumbo, a super jumbo, an ARM product, an interest-only product, a 30-year fixed, a 15-year fixed, the loan program itself and the loan amount both play a role in what interest rates you're getting. So knowing and asking about, okay, well, what if I did a 10-year ARM instead of a 30-year fixed? That will change your interest rate. What if I paid a little bit more money down and got a conforming loan instead of a jumbo, or I put a little less down and got a jumbo instead of a conforming, or I went with the FHA instead of a low down conforming? All of those are triggers, and a seasoned loan officer is obviously going to present to you the best options for you that they see based on the storyline and your projections of that home experience. But it's fair to ask, like, hey, what might move the needle in a better way on the interest rate? Again, interest rate is an important piece, but your monthly payment is really what the underlier reasoning for asking is. You're trying to get a monthly payment that fits your budget and a monthly payment that allows you to stay in that home and sleep well at night and flourish as a overall human being, and not be so constrained by that monthly payment that you can't do the things that are important to you in the overall life. So all of these pieces go into what your interest rate is. And lastly, most commonly in jumbo loans, whether you have certain credit history, you meet certain credit history requirements. So whether you have 3 open trade lines versus 1, whether you have 3 open trade lines and 24 months of history versus 1 or 0, that matters in the jumbo space, as it determines certain different banks or investors that you might be able to use and choose compared to others that are going to block you out because you don't meet their guideline requirements. So guidelines play a big role in which investors on the jumbo front you can move forward with. Equally, whether you have to go with an FHA or a conforming loan, that might sway one way or the other. So being in contact with the loan officer about which is more, whether guidelines are holding you back from choosing one program or another to be able to get the lowest rate out there, is important to know. And all of this is why it's so important to talk to a loan officer as soon as you just have an inkling interest of buying a home, as it ensures that you can plan. Loan officers don't charge you to meet with them, to talk to them, to plan this out. So there's no risk in getting that information early on about yourself and where you stand now. It only allows you to better plan and ensure that that path leads to the most optimal outcome on that interest rate mortgage payment when the time does come to buy. And I find, frankly, it actually inspires people to be a little bit more clear on the path that they have in regards to their employment, their self-employment, how much money they're making, how much money they're saving, etc. That really does add a lot of value financially to their life, and hopefully overall to their, your confidence and where you're going, and the happiness index. So I hope this is really helpful. Again, hit the subscribe button, like button, share, comment. I'm here for you, and that's why I'm creating this content. So I hope it's helpful, and I hope it ensures that you are setting yourself up for success. So until next time, enjoy, and we'll be in touch. Thanks. Jeff Boxler here.